Welcome to an introduction to REITs, or what we're calling REIT 101. My name is David Auerbach. I'm the Chief Investment Officer of Hoya Capital. And joining me is Jonathan Morris, or Professor Jonathan Morris, the founder of REIT Academy and a REIT professor at Georgetown University. In today's presentation, we're going to talk about the history and background of the REIT sector, the 1960 Act that created REITs, the dawn of the modern REIT era. And we're also going to go through a whole bunch of definitions, terminology, investing in the sector, talking about the property types, valuation methods, and where else you could find additional information. As we kick this off, Professor, I'd like to share a presentation here from Hoya Capital that we'll kind of use as a milestone or as a milepost as we go through our conversation. So let's start out as the whole, Professor. What is a REIT?
What is a REIT? A REIT is a real estate investment trust, R-E-I-T. Investment trust. And
what is a REIT, Professor?
A REIT is a real estate investment trust, R-E-I-T. It is a company, an entity that owns commercial real estate properties. Go ahead.
What does that mean exactly? Can any company be a REIT? What does that mean?
No, a company that is intending to be a REIT needs to create the documents necessary to become a REIT. Once they are approved by the Securities and Exchange Commission, or the SEC, they can then pursue the acquisitions and development of properties, typically in a single asset class or property type. So we have different REITs, which I know you'll get into in a minute, that own office buildings or shopping centers or apartment buildings. Each of those is called a REIT sector, and those are just 3 out of the 14 or 15 REIT sectors that exist today.
So I have the slide up here that talks about the REIT rules. So from the structure level, can you maybe highlight some of the most important rules in order for a company to qualify as a REIT?
Sure. The intent is that the company is focused on generating revenue from real estate properties. So a minimum of 75% of the revenue from the company, the REIT, must come from either leases or rents for real properties. There are a few other detailed elements that you need to have to qualify for a REIT, but as you go through the list, you'll find that most of these can be met within the time frame that they need to be met. The 100 shareholder rule, there's a 90% of taxable income payout requirement, which means the company takes 90% of its taxable income and sends it to shareholders. So the rules are important, but they're all doable, and no one seems to get hung up on them.
So as you mentioned that there are all of these different sectors, let's go way back in time, Professor. NAREIT has this great table on their website. By the way, Professor, what's NAREIT?
NAREIT is the National Association of Real Estate Investment Trusts.
What does that mean?
They are the national association for the industry. They lobby for the industry. They create research for the industry. They create committees for the industry. It's a very big organization that was started basically at the same time REITs were started.
So I have this timeline of REITs, and I guess we can't talk about it without the history of REITs. And as somebody who teaches a course on this, let's go back in time 65 years, Professor, to 1960. Walk us through the start of the REIT industry.
1960 was a period where the United States economy had time to heal from World War II, from the Great Depression. And at the end of those disruptive events, we had a calm period for about 10 to 12 years. at which time the middle class became a major thing. People were working, they were having families, they were buying their first home. And as time went by, the middle class saved as much money as they could. Their only investment alternatives were basically a certificate of deposit down at their local savings and loan. They didn't know about the stock market, so they really didn't participate in it. But they also drove by shopping centers and apartment buildings, and they always wondered, how can I, the middle class hard worker, invest in properties such as those? When they found a way to find out, they realized that those developers did, in fact, welcome investors into their projects. But the minimum investment, even back then, was about 500,000 just to get involved. So the middle class could not afford that. The idea of a real estate investment trust was to democratize the investment in commercial real estate. These REITs became public companies, traded on the stock exchanges, and you could invest as little as $1,000 or $2,000 or $5,000 in any one of these public REITs and immediately participate in the commercial real estate that they owned.
Can you walk us back to like resolution trust and how that kind of played into all of this? Again, going back to the beginning of time.
Yeah. So 1960, Congress passed the legislation that that allowed for the creation of REITs. After 1960, the industry became what I would call a cottage industry. There were several REITs that went public within the first 5 years after the legislation. But the truth of the matter is, it didn't grow substantially. And the reason it didn't is because developers had access to lots of different capital sources to build their buildings. Uh, as the 80s dawned, in 1981 and 1982, the US economy really picked up steam and businesses were growing. The federal government was growing. And lo and behold, the demand for office space grew substantially in every major metro. Now, I'm sitting here in Washington, D.C. The downtown portion of Washington, D.C. was growing like a weed. Law firms wanted more space. Accounting firms wanted more space. Associations wanted more space. And the federal government wanted huge blocks of space to grow. So developers were building new office buildings on land that they had owned for decades in downtown DC. And by the time they got to the point where they're finishing the building, they had already leased the entire building, either to law firms, accounting firms, or the federal government. And those were huge wins for these developers. So they took that capital and they reinvested it in the next office building and the next one and the next one. And that continued from around 1982 to about 1986, 87. Interestingly, when 1986, 1987 came around, the tenants that were in the market had satisfied their needs for office space. And the newest buildings that the developers built sat empty. Now, as you know, Dave, when you build a new building, you get a construction loan, which you have to guarantee, and you put in the land that you've owned for a long time. As time goes by, you build the building, and your hope is that you'll be signing leases during construction. Nobody signed any new leases. By the time the building was completed, there were no leases whatsoever. And then a year or two goes by, and the lender, the bank, is now forcing you to be foreclosed on that building, meaning the bank is going to take the building away from you. And all of the money and time that you invested in building it is gone. Okay? So that started 87, 88. The next shoe to drop was those very lenders, those banks that were taking the properties back, they failed as well. They couldn't meet their reserve requirements. They couldn't meet all of the checks and balances that they need to have to be an operating open savings and loan under the FSLIC, which is the Federal Savings and Loan Insurance Corporation, and FSLIC shut them down. So that was 89. Congress got in the act and they saw what was happening. The good news was all of this destruction of value was pretty much focused on the commercial real estate industry. But Congress was worried that it was going to migrate into the US economy and start having a negative impact on the US economy. So the Congress raced to create a new federal agency called the Resolution Trust Corp. The Resolution Trust Corp, based in Washington, D.C., was set up specifically to take over all of these failed properties that had gone back to the banks, and then the banks failed. So the Resolution Trust Corporation, 1989, became the recipient of all these projects that were over-levered, never leased, and the RTC took them in, and their goal was to sell them as quickly as possible. So you had all these properties coming into the RTC, and the RTC staff was basically taking the highest bid and selling them. Now, they may have received a $100 million office building that had failed. Some of the investors who went to the RTC to buy these properties, they could have bought that building for $10 million. Now, it had no tenants and it had no cash flow. But to buy a $100 million office building for $10 million to someone looked like a good deal. And as it turns out, it was.
So you mentioned a handful of REITs started trading in the 60s. I think the most famous example that still exists today would be Kimco. Is that correct?
No,
What
that was 1990.
what legacy REITs that we know today are the earliest going back in time?
Well, Washington Real Estate Investment Trust, now called ELM, went public in 61 or 62. Federal Realty, a big shopping center REIT, went public right after the law was passed. And there were a group of REITs that went public. On that note, interestingly, we didn't have the internet back then. I wasn't around yet, but the new REITs that came to the market were actually based in DC. And the reason for that is the headline news got out very slowly in America. It would take days for people across the country to find out that Congress passed a law to create REITs. But the folks in DC, particularly the lawyers, knew about it immediately. And they turned to their entrepreneurial clients and some of their real estate clients and said, hey, you can form a REIT now and finance and capitalize your assets. And they did. But what you're talking about is what's called the dawn of the modern REIT era. And this is where things got very interesting very quickly. As I mentioned, 88, 89, all these properties were failing miserably. However, there were many, many, many developers that owned large portfolios of properties that never got into trouble. They never raced ahead to build a building without tenants. And unfortunately for them, the financial industry looked down their nose at the portfolios that they owned. Whereas just years before, they were happy to lend them money. But now that all this was going on and the RTC formed, these lenders, for all intents and purposes, shut down. They did not want to lend on commercial real estate. No one wanted to invest in commercial real estate. And even for those companies that were going concerns, had been in business for 20, 30, 40 years, they couldn't get new loans. And that was becoming a big problem. So in early 1990, two investment bankers, one at Merrill Lynch, one at Goldman Sachs, came up with the idea, why don't we bring out the REIT model that was started in 1960 and introduce it to these developers and property owners who had been around for, decades and suggest that they convert their holdings into a REIT. So they take all their properties, they put them into the REIT, and then the REIT goes public in an IPO. Well, it didn't take long for the executives, the chairman, the CEOs of these companies to say, let's go, let's do it. And in 1993 and 1994, a combination of 24 months, a total of nearly 100 new public REITs were formed. Now, today, as you know, Dave, we have about 185 public equity REITs. So to have 100 of them formed inside of 24 months is pretty dramatic. By the end of the 1990s, by 1999, we had a grand total of 154 public equity REITs formed from 1991 to 1999. So the vast majority of today's public equity REITs were formed during the 1990s.
One takeaway, 154 in 99, 185, 200-ish today. But that also doesn't count all the guys that have merged and gone away. So really, if you add up all the incrementals, like, the Rexons, the ROICs, EOPs of the world, it was really about 225 to 250 names that we had in our universe. But let's shift gears just a little bit. I have this slide up here of equity versus mortgage REITs, public versus private. And then there's also this thing called OP units, Professor, which is different than your typical stock. So can we maybe unpack a couple of these different things? What's the difference between an equity and a mortgage REIT? What's the difference between private and public? And what's the difference between a publicly traded share and an OP unit?
Okay. So let's start with equity versus mortgage. So up until this moment, what I've been talking to you about are equity REITs. Equity REITs are formed, go public, and they raise capital. That capital is equity capital. And they use that equity capital to grow. They buy properties, they develop properties, they buy properties that are existing but need renovation. And that's an equity REIT. They are issuing stock on the New York Stock Exchange to raise capital, which they will invest in real properties. And that's the key phrase, invest in real properties. A mortgage REIT, on the other hand, also goes public and raises capital. But what they do is they invest in loans. They invest in mortgages. So the assets of a mortgage REIT happen to be debt, mortgage debt, loans. In some cases, these REITs actually make loans. So the difference is very stark between an equity REIT and a mortgage REIT. Equity REIT, real property is owned. Mortgage REIT, loans are owned.
What about risk? Is a mortgage REIT considered risky? Is an equity REIT considered risky? I know it's kind of a loaded question, but how do you view it?
So mortgage REITs own loans. If a mortgage REIT started out 10 years ago and went public and raised capital, they would start buying loans. The way interest rates run, they run in cycles. And this is interest rates. So if this REIT started out life right here, and over the first 5 years, they bought loans, and the interest rates were right here. Okay, I'm not even going to give you any numbers. I'm just telling you, if interest rates were right here, their portfolio would be full of loans at these interest rates. We're very close. When interest rates go up, which is typically at the end of a 7-year cycle, they're much higher than they were when the mortgage REIT was buying these loans. And what happens is when rates go up, prices of these loans or values go down. So by no fault of their own, the mortgage REIT has been acquiring loans during this lower era of interest rates. But as time goes by, when interest rates rise, it will have a depressing effect on the value of their portfolio. So the risk inherent in mortgage REITs is much more aligned with where interest rates are today and where they're going to be versus equity REITs. Does that make sense?
Let's build on that. We hear in the industry that REITs are interest rate sensitive. Now, we know we've just discussed it on the mortgage REIT side, but are equity REITs interest rate sensitive?
That's a great question. Back in the old days, when I started, equity REITs were not as interest rate sensitive as they are today. Today, almost every commodity, whether it's homes or REITs or anything that has value, is sensitive to interest rates. Now, one big reason for that is that when you buy a property, you typically borrow money to do so. And when you borrow money and interest rates are going up, the money costs you more and more each time rates go up. And that means that the capital, the cash that comes from the building has to go further and further toward paying the interest, the debt service on those loans that it may have 6 or 12 months earlier. So yes, public equity REITs are interest rate sensitive more so than they had been. And there's another reason for that. An investor that wants to buy into a REIT will receive, we'll talk about this, I know, but they'll receive a dividend. The dividend's paid quarterly, but it's expressed on an annual basis. So let's say the dividend's 4% a year. If interest rates in the market are 2.5%, then 4% looks like a good investment. But if interest rates go up to 4 or 4.5 or 5%, and these investors can buy treasuries or high quality bonds for 4.5 or 5% return, then the question is, why not do that and not take any risk of buying into a REIT which owns a portfolio of properties? So there is competition from fixed income investments like bonds and treasury securities when interest rates go up. Under normalized circumstances, the REIT dividend is typically greater than the current interest rates. And that is not quite true today, but they're about at par. So if REIT dividends went up or interest rates went down, the REITs would look like a better investment for, any investor that's looking for that type of return.
Can we talk public versus private?
Of course. So,
What is the difference between a public REIT and a private REIT?
So remember, I said the REIT gets formed and it goes public. That's just the start. When the REIT goes public, it sells stock in itself. The company is selling a portion of itself, its own portfolio, into the market. That stock is traded on an exchange, New York Stock Exchange, NASDAQ. We used to have the American Stock Exchange, and that means that it's liquid. So if you want to buy shares in a REIT today, and next week you wake up and you say, maybe I shouldn't have done that. You can pick up the phone or go on your laptop and put in a sell order, sell your shares, 24, 48 hours later, you have your cash. Fully liquid. They also file their audited financial statements with the SEC, and myriad other reports have to be filed with the SEC. That's called transparency.
So I'd like to pause, and I have the slide up here that talks about the advantages and characteristics of REITs, where we highlight liquidity, transparency. So we're going to go back and forth between the couple of slides here, but for those that are watching this, they could see this table that you're talking about. Go ahead.
So liquidity is a very important feature. Now, when someone buys REITs or they buy REIT stocks, they don't think about that. They really don't, because they've done some homework, they've talked to some people, they've read some reports, and they make the investment. And they watch it, it goes up, it goes down, et cetera, et cetera. But they don't think about it until they need the money. And when they need the money, they typically need it right away. With public equity REITs, they can sell those shares and have their cash in a matter of days. And that's a very important positive benefit for public REITs. So I just want to stress that. And that's relates to public REITs. Transparency, we talked about. If you want to find out any information about the company you invested in, there are a few websites you can go to, principally the Securities Exchange Commission's website. Every piece of information about that company is on the website, and it's updated daily. Now, dividends are another big thing we talked about. So if somebody says, I bought a REIT stock and it's got a 6% dividend yield, what they mean is they may have paid $20 a share for the stock. At 6%, they're getting $1.20 per share a year, and it's paid 4 times a year. So 120 by 4 is 30 cents, or 30 cents a share, paid 4 times a year quarterly.
How is that taxed?
It's taxed in a variety of ways, but before I tell you, I will also tell you that REITs do not pay federal income taxes. REITs, what they call, pass through their earnings to you, the shareholder. And however those earnings were derived go directly to the shareholders. So some of those earnings might be what's called return of capital. That's taxed at 0. Some of the earnings that you get out of your dividends may be from leases or rents. That's taxed at ordinary rates, your ordinary rate. You take that income, you put it on your 1040, and then you figure out your taxes. And some are taxed at what's called capital gains. If the REIT sold a property and distributed the income, that's capital gains income, typically at 20%. There's no hard and fast rule because each REIT is different. But these are the 3 flavors of what you may pay in taxes on your dividends.
So what about private REITs then? I guess keep the public stuff up there, but what's the difference now with a private REIT?
A private REIT is set up for a particular purpose. The sponsor, the entrepreneur who sets up a private REIT, is pretty much interested in the structure that it holds. They're not interested in going public. They're not interested in creating a publicly traded stock, but they are interested in the structure that the REIT has, which happens to be a very flexible structure in owning commercial real estate. So there are many, many, many private REITs in the country, and you don't hear about them. They don't advertise openly, but they're structured for a reason. And one of the benefits of a REIT, whether it's public or private, is that it is intended to be a growth vehicle. So if you have a portfolio of 20 properties and you think about creating a REIT out of those 20 properties, if your intention is to grow from 20 to 21 to 24 to 25 properties, a REIT may very well be a good alternative. If your intention is just to keep those 20 properties distribute the income to the owners, which you may be one of, but not grow the portfolio, a REIT may not be the right method. A traditional limited partnership may do just as well, but a REIT is intended to grow whether it's public or private. Now, of course, private REITs don't have liquidity. They don't file with the SEC. Their investment is denominated in stock, but that's pretty much the only similarity. If you want to find out what's happening to the private REIT that you invested in, you may get a report every quarter, but it's going to be very limited in scope. If you really want to find out what's going on, you go meet with the executives of the private REIT, wherever they may be based, and sit down with them for a couple of hours. Now, they're not beholden to tell you anything. It's not a public company, but they'll probably chat with you since you're an investor. But the difference between a public REIT in terms of disclosure of information, which is 100%, and a private REIT, which is whatever the sponsors want to tell you, is like day and night. So if you really trust the sponsors and you've done deals with them before and they've gone well, you may invest again with them in a private REIT. However, if you don't know the sponsors and you want frequent updates on your investment, it's probably better to go with a public REIT.
And then what about OP units? How does that differ than all of this stuff?
So OP units are a result of a watershed moment in 1992. A company by the name of Taubman Setters, who built malls, they and their council invented a new REIT structure called the UPREIT, Umbrella Partnership Real Estate Investment Trust. And what that did was it enabled the owners of each of the properties that came into the REIT a chance to exchange their interest in the property. Now, remember, the property was illiquid. The interest may have paid some cash each year, but they had a chance, a one-time chance, to take those interests and move them into the new REIT. In exchange, they did not get cash. They got interests in the new REIT, which are called operating partnership units, okay? Those are not liquid either, but they can become liquid at some point in time. They need to go through a few steps, but it was an attractive enough alternative to what they owned, which were limited partnership interest in individual properties, that those who were offered this chance accepted it. So the REIT is here, and below it is something called the operating partnership. And the folks that owned interest in the properties that would come into the REIT before they went public, they did so by contributing their limited partnership interest in, and they got OPUs out. Now, two other things. The dividends for the OPUs are identical to the dividends for the stock. Number two, the valuation for each OPU is identical to whatever the stock is that day on the exchanges. But they don't have
The
immediate.
the last section I want to talk is about the metrics.
Okay.
And then if we have interest and this takes off, we'll do part two, doing a little bit of a deeper dive. But let's talk about the metrics. Walk us through revenues, expenses, all that fun stuff. And I have the slide up here, but to get to what we refer to as NAV. So walk us through getting to NOI to get to NAV, if you can go through some of that stuff for us.
All right. Well, let me give you a preamble. Remember,
We've got about 5-6 minutes, just so you know.
All right. We're talking about public companies in this case. Okay. Public companies have always had to adhere to what's called generally accepted accounting principles. And that's a mouthful, but GAAP or GAAP are the accounting rules that govern how you report to shareholders by a public company. And what happens with that is It takes the traditional NOI or net operating income from the private sector and it changes it. It changes it quite dramatically, in fact. So across the entire spectrum of commercial real estate in the private world, net operating income is really the number you want to know of any property before you begin analyzing the property or the income or any valuation of the property. When GAAP changes NOI, everything changes. So in the first situation, you got revenue minus operating expenses plus depreciation, and that equals NOI. The blue square plus depreciation is debatable, but what's not debatable is revenue minus OPEX equals NOI. Then you go to EBITDA, earnings before interest, taxes, depreciation, and amortization. Now that takes you closer to cash flow or closer to NOI in the private world. The reason is because it takes your revenue, less expenses, add back some depreciation, and then it reduces it by the overhead. Now the overhead or G&A, general administrative expenses, is the dollar cost to run the REIT. Remember, if the REIT's got 30 properties in it, it also has a CEO, CFO, and lots of other people running the REIT. If a private sponsor had 30 properties, they may be owned in a partnership, and the partnership doesn't have all those expenses. It's got expenses, but it doesn't have salaries and bonuses and everything that goes with operating a public company. So by reducing that from your revenue, it gets you closer and closer to NOI. And then the big one is funds from operations. So FFO is typically the headline earnings metric. And that includes the add back of what's called depreciation and amortization as the big changes. So FFO takes NOI and increases it. And that is also a debated metric because on the private side, NOI is as pure as it can get. On the public side, FFO is not pure cash income that may be distributed to shareholders. It is truly an accounting metric. The next one down is AFFO. Now, for me, I like AFFO much better than FFO because it adjusts it. It takes FFO and adjusts it to make it more similar to net operating income. Now, there's a couple of other metrics that aren't here, but one of them is called funds available for distribution. And that number is the amount of cash available to distribute to shareholders. It's not on the chart. But what I want to point out is that AFFO, adjusted FFO, gets you closer and closer to how much cash the REIT can send to shareholders, which, by the way, is the most important thing for an investor because that's the cash that you're going to get. Last but not least, there's net asset value or NAV. Now, NAV is expressed in a per share number. So it's NAV per share. And here's how you get there. And this is the analogy I draw. CEO of a REIT, been running the company for 12 years. The stock has been trading low for the last 3 years. And he wakes up one day and says, I think it's best for my shareholders if we sell the company. He goes into the office, he talks to the board members, he talks to his executives. They begin down the path, and they're going to sell every asset that they own for the highest price they can get. So once they do that, they're going to get a big pile of cash. That pile of cash is a big number subtracted for the debt. So they do have debt on their portfolio. They're going to take the cash, which happens to be gross asset value, subtract their debt, that equals net asset value. But we're not done yet. We're going to take the net result. Let me come bring it up here. We're going to take that dollar amount. So sale of properties, cash minus debt equal net asset value just in cash. So we're going to take that big number of cash and we're going to divide it by the number of shares and units outstanding. Okay. So let's say this is nets down to $1 billion. That's what's left. 1 billion in cash. And let's say we have, well, make it easy. Let's say we have 100 million shares outstanding, shares and units. That would be $10 a share. NAV. Okay? $10 a share is your NAV. But that means nothing until you look at the stock price. And let's say the stock price is $6 a share. Now, what does that mean? You sold all your properties, you paid off all your debt, and you have $10 a share to distribute to your shareholders. Why would the stock market price your stock at 6 if you can get 10? Something's not right. So while we really don't go through all this exercise to sell everything and pay off the debt and, let everybody go home and that's it, there's a big difference between what the stock market is pricing your shares at and what your NAV is. And that's where the conundrum comes in. The difference between 6 and 10 is pretty pronounced. So this is the stock market's value. That's your legitimate value. And the question becomes, how can I convince the stock market that our value is much closer to 10 than it is to 6? And that's a heavy lift. But good CEOs, good CFOs, good investor relations people can make the argument day in and day out that the stock should be closer to 10 than 6. And sometimes they'll prevail. Does that help?
Very much so. Professor, thank you so much for spending the past hour doing a REIT 101 class with us. If you'd like to learn more about REITs, I highly suggest you check out Jonathan Morris's REIT Academy, REITacademy.com. If you'd like to learn more about Hoya Capital and the slides and all that stuff, you can reach out to us at hoyacapital.com. And if you like this video, let us know, and we could do more of these for you, going deeper and deeper into the REIT sector. So, Professor Morris, thank you again for your time, and I hope to be chatting with you again soon.
Thanks, Dave. Really appreciate the time.